Listen carefully, because if you are holding 500 ounces of silver today, you may be looking at your position the wrong way. Most people believe silver is simply a defensive asset. They think it is something you buy, store away, and forget about until inflation appears in the headlines. They see it as insurance, they see it as a hedge, they see it as a backup plan sitting quietly in the background while the financial system continues functioning as it always has. But I believe something far more important is developing beneath the surface. I am not talking about a minor correction. I am not talking about a temporary market event. And I am certainly not talking about a prediction based on next week's price action. I am talking about a shift in the environment itself. You need to understand what is happening, because the value of silver has never been determined only by supply, demand, or short-term speculation. The real story has always been connected to confidence. Confidence in currencies, confidence in governments, confidence in debt markets, confidence in the idea that policymakers can continue managing an increasingly complex financial system without consequences. History has proven this again and again. Major financial transitions rarely announce themselves in advance. They do not begin with panic. They do not begin with dramatic headlines. They begin quietly while most investors remain focused on familiar narratives. By the time the majority recognizes the shift, the most important positioning has already taken place. That is why this moment deserves attention. Most people continue looking at stock indexes and assuming everything is normal. They look at employment data. They look at quarterly earnings reports. They look at technology companies and assume the future will simply be an extension of the recent past. But the deeper forces shaping markets are moving elsewhere. The foundation of the modern financial system rests on debt. Governments borrow, corporations borrow, consumers borrow. Entire economies depend on the continuous expansion of credit. For decades, this structure worked because interest rates remained relatively manageable and liquidity remained abundant. The problem is that every debt cycle eventually reaches a point where main stability becomes increasingly difficult. The real question is not if pressure develops. The real question is when that pressure becomes impossible to ignore. Today, global debt levels sit near historic extremes. Governments continue spending beyond revenues. Deficits remain persistent. Borrowing requirements continue expanding. Meanwhile, central banks face a challenge that becomes more complicated every year. They must contain inflation without damaging growth. They must preserve confidence without encouraging excessive risk-taking. They must support financial stability while attempting to maintain the purchasing power of national currencies. Those objectives often conflict with one another. This is where investors begin making mistakes. Many assume policymakers possess unlimited flexibility. They assume every problem can be solved through monetary intervention, fiscal stimulus, or emergency support measures. But every solution creates new consequences. More debt requires more unfinancing. More stimulus creates inflationary pressure. More intervention increases dependence on future intervention. Eventually, the system begins creating vulnerabilities faster than it solves them. This never ends quietly. The signs emerge gradually. Bond markets become more sensitive. Government financing becomes more expensive. Currency purchasing power weakens over time. Investors begin questioning assumptions they once considered unquestionable. And when confidence begins changing, capital begins moving, not all at once, not dramatically at first, quickly, strategically, almost invisibly. That movement is what serious investors watch, because when capital starts searching for protection from monetary uncertainty, assets with limited supply suddenly become more important. This is one reason Ray Dalio has spent years discussing long-term debt cycles, monetary transitions, and the importance of understanding how financial systems evolve over time. The lesson is not about predicting exact dates. The lesson is understanding patterns throughout history. Periods of excessive debt eventually force difficult adjustments. Sometimes those adjustments arrive through inflation, sometimes through currency weakness, sometimes through economic stagnation, sometimes through a combination of all three. But the outcome is often similar. Investors begin seeking assets that exist outside the promise-based financial structure. Silver occupies a unique position in that conversation. Unlike many financial assets, silver is not dependent on somebody else's obligation. It is not a promise to pay. It is not a liability on a balance sheet. It exists independently of political decisions and monetary policy. That matters more than most people realize. But there is another side to the story that makes the current environment even more interesting. Silver is not merely a monetary asset. It is also a critical industrial resource. Modern economies require massive amounts of electrical infrastructure. Advanced electronics require silver. Data networks require silver. Renewable energy systems require silver. High-performance manufacturing requires silver. As technology becomes more integrated into daily life, demand continues expanding. At the same time, increasing supply is not simple. Mining projects require years of development. Regulatory challenges continue growing. Production costs remain elevated. New discoveries become harder to bring into operation. When growing demand collides with constrained supply, pressure builds. For years, that pressure remained largely hidden. Now it is becoming harder to ignore. And that is why silver holders should pay close attention. Because what Ray Dalio sees coming is not necessarily a single event. It is a developing environment. An environment where debt burdens are growing. An environment where monetary policy becomes increasingly difficult, an environment where confidence matters more than ever, and an environment where assets that combine scarcity with real-world utility may begin attracting far more attention than they have received during the past decade. Now, when I talk about attention returning to silver, I want to be very clear about something. I am not suggesting that every investor suddenly wakes up tomorrow morning and rushes into precious metals. Markets rarely function that way. Major transitions unfold through stages. First comes doubt, then curiosity, then recognition. Only later does broad participation arrive. The investors who understand this process are usually the ones who benefit the most. Most people wait for certainty. They wait for headlines. They wait for experts to tell them the opportunity is obvious. But by the time opportunities become obvious, much of the adjustment has already occurred. That pattern repeats throughout financial history. Look back at previous monetary transitions. Look back at periods where inflation unexpectedly accelerated. Look back at moments when confidence in policymakers weakened. The biggest moves often occurred before the majority fully understood what was happening. The reason is simple. Markets are forward-looking. They react to changing expectations before the public recognizes those changes. This is where silver becomes particularly interesting. The silver market is remarkably small when compared to the size of global financial markets. Trillions of dollars move through equities, bonds, currencies, derivatives, and institutional portfolios every day. Against that backdrop, the total investable silver market is tiny. That creates a situation many investors underestimate. It does not require enormous capital flows to create meaningful price movements. It requires only a relatively small shift in allocation. Think about that carefully. Large pension funds manage hundreds of billions of dollars. Sovereign wealth funds manage hundreds of billions more. Insurance companies, endowments, family offices, hedge funds, and institutional asset managers collectively control extraordinary amounts of capital. If only a fraction of those assets begin searching for alternatives to traditional financial instruments, the impact can be significant. And this is precisely why small markets can experience dramatic repricing. Not because everyone suddenly agrees, not because speculation becomes irrational, but because available supply struggles to accommodate changing demand. That dynamic has appeared repeatedly throughout history. For long periods, silver remains overlooked. Interest fades, investors become distracted, the market drifts sideways, then something changes, the economic environment evolves. Confidence begins shifting, capital starts moving, and suddenly the market behaves very differently than it did during the previous decade. Most people misunderstand what causes these transitions. They assume price creates interest. In reality, changing conditions create interest and price eventually follows. That distinction matters, because if you are holding 500 ounces of silver, your position should not be viewed solely through the lens of daily price fluctuations. The larger question involves the forces surrounding that ownership. Ask yourself this: what happens if inflation proves more persistent than policymakers expect? What happens if governments continue relying on deficit spending because reducing expenditures becomes politically difficult? What happens if debt servicing costs continue rising? What happens if economic growth slows while financial obligations continue expanding? These are not extreme questions. These are reasonable questions. And serious investors ask them because serious investors understand that systems under pressure eventually require adjustment. Sometimes those adjustments occur gradually, sometimes they occur suddenly, but they occur. The modern financial system has reached a stage where trade-offs are becoming increasingly visible. For years, low interest rates encouraged borrowing, governments expanded spending, corporations refinanced repeatedly. Asset prices benefited from abundant liquidity. Consumers relied heavily on credit. The structure appeared stable because financing remained relatively easy. But structures built on expanding debt become more fragile when financing conditions change. This is one reason volatility has begun appearing across areas of the financial system that many investors previously considered predictable. The assumption that stability can be maintained indefinitely becomes harder to defend when debt levels continue growing faster than productive economic output. That is not a political statement, it is a mathematical reality. Debt eventually requires servicing, interest expenses eventually matter, and confidence eventually becomes important. Confidence is often the most misunderstood component of financial markets. People focus on economic statistics. They focus on earnings, they focus on growth projections, but confidence influences all of those variables. As long as investors trust institutions, systems function smoothly. When trust begins weakening, behavior changes. Investors become more selective, capital becomes more defensive. Risk assessments change, portfolio allocations change, and assets previously considered unnecessary begin attracting attention. Silver has historically benefited from those shifts, not because it generates income, not because it produces quarterly earnings, but because it represents something fundamentally different. It represents scarcity. It represents independence from monetary policy. It represents ownership that exists outside the traditional promise-based financial framework. That distinction becomes increasingly important during periods of uncertainty. Now consider another factor. The world is undergoing a significant technological transformation. Electrification continues expanding. Data infrastructure continues growing. Artificial intelligence requires enormous computational capacity. Energy systems require modernization. Telecommunications networks continue developing. All of these trends consume resources. Many of those resources can be substituted. Silver often cannot. Its unique conductive properties make it extraordinarily valuable in advanced applications. This creates a fascinating situation. Monetary demand and industrial demand may both strengthen within the same period. Historically, those forces do not always move together. But when they do, the market becomes highly sensitive. That sensitivity is exactly what experienced investors monitor, because markets rarely wait for universal agreement. They respond to incremental changes, a little more demand, a little less supply, a little more uncertainty, a little less confidence. Over time, those seemingly small adjustments create powerful outcomes, and most people fail to recognize them because they expect dramatic warning signs. The reality is usually much quieter. The biggest transitions often begin while public attention remains focused elsewhere. That is why understanding the environment matters. The price of silver tomorrow is not the most important issue. The next week is not the most important issue. The deeper issue is whether the financial landscape entering the years ahead will resemble the landscape investors became accustomed to during the era of cheap money and abundant liquidity. Because if it does not, then asset allocation decisions may look very different than they have during the past generation. And if that happens, silver may no longer be viewed as a forgotten defensive holding. It may begin to be viewed as a strategic asset positioned at the intersection of monetary uncertainty and industrial necessity. That possibility deserves serious consideration. This is where the conversation becomes even more important, because markets are driven by more than balance sheets, interest rates, and economic forecasts. They are driven by perception, they are driven by expectations, and most importantly, they are driven by collective belief. For decades, investors operated inside a framework that appeared reliable. Governments borrowed. Central banks intervened when stress emerged. Bonds provided stability. Equities delivered growth. Liquidity supported markets whenever conditions deteriorated. That framework created confidence. And confidence encouraged risk-taking, but every financial era eventually encounters limits. The question investors must ask today is whether those limits are becoming more visible. Look around the world, debt burdens continue expanding. Fiscal deficits remain elevated. Governments face increasing obligations. Demographic pressures strain public finances. Economic growth struggles to keep pace with long-term commitments. At the same time, central banks remain trapped between competing objectives. They want price stability, they want financial stability, they want economic growth, they want confidence. But achieving all of those goals simultaneously becomes increasingly difficult as structural pressures accumulate. This is not speculation. It is the natural consequence of highly leveraged systems. The larger debt becomes, the more sensitive the system becomes to financing conditions. The greater the dependence on intervention, the greater the expectation of future intervention. And the greater those expectations become, the more fragile confidence can eventually become. This is why experienced investors pay attention to long-term cycles. They understand that economic systems move through phases. Periods of expansion create optimism. Optimism encourages borrowing. Borrowing fuels growth. Growth supports asset prices. Eventually, debt reaches levels that create new constraints. At that point, the environment changes. The transition is rarely comfortable, and it is rarely obvious in real time. Most people continue operating under assumptions formed during the previous cycle. They assume conditions will normalize. They assume old relationships will return. They assume temporary stress will disappear. Sometimes it does. Sometimes it does not. The investors who navigate these periods successfully are usually the ones willing to question prevailing assumptions before everyone else. That is why ownership matters, not just ownership of silver. Ownership of understanding, ownership of perspective, ownership of the ability to recognize structural developments before they become headline news. Because by the time headlines explain a transition, much of the opportunity has often disappeared. This brings us back to silver. Silver occupies a position that few assets can replicate. It combines monetary relevance with industrial necessity. It participates in technological expansion while simultaneously benefiting from concerns surrounding currency purchasing power and financial stability. That combination is unusual. Most assets depend heavily on a single narrative. Silver does not. And because the market remains relatively small, changing investor behavior can have an outsized impact. This is why historical silver advances have often surprised people. The moves appeared sudden, the explanations arrived afterward. Analysts rushed to identify causes. Commentators searched for narratives, but the underlying conditions had usually been developing for years. Supply constraints, growing demand, changing monetary conditions, shifting investor psychology. All quietly building beneath the surface, then attention returned, capital followed, and price adjusted. History has demonstrated this pattern repeatedly. That does not mean outcomes are guaranteed. No market moves in a straight line. No asset rises without volatility. No opportunity develops without uncertainty. But understanding the environment allows investors to interpret volatility differently. Short-term fluctuations become less important when viewed against long-term structural forces. Daily headlines become less significant. Temporary setbacks become easier to evaluate. Perspective changes everything, and right now, perspective may be the most valuable asset an investor can possess because the world appears to be entering a period where debt, inflation, monetary policy, and confidence will play increasingly important roles in shaping investment outcomes. Those forces are interconnected. They influence one another, they compound over time, and they rarely remain contained forever. The real issue is not whether silver experiences volatility. Volatility is normal. The real issue is whether investors recognize why interest in scarce assets tends to increase when confidence in financial promises begins to weaken. That is the lesson history continues teaching again and again across countries, across currencies, across generations. When uncertainty rises, people search for stability. When confidence weakens, people seek alternatives. When systems become strained, capital begins repositioning. Not all at once, but steadily. And those gradual changes can eventually produce dramatic results. If you hold 500 ounces of silver today, the most important question is not what happens next week. It is not what happens next month. It is not even what happens next quarter. The most important question is whether you understand the larger forces gathering around your position, because silver may represent far more than a simple metal. It may represent a signal about debt expansion, a signal about monetary policy, a signal about inflation risk, a signal about confidence in the financial architecture that has defined markets for decades. Signals like these do not appear without reason, and they rarely become visible by accident. The investors who benefit most are often not the fastest traders. They are the individuals who recognize structural change while others remain distracted by short-term noise. They understand that major transitions begin quietly. They understand that confidence can change. They understand that cycles matter. And they understand that preparation almost always matters more than reaction. That is why silver holders should pay attention, because what Ray Dalio sees coming is not necessarily a single event. It is a changing environment, an environment where debt burdens remain elevated, an environment where policy choices become increasingly difficult, an environment where capital may begin searching for new anchors of stability, and an environment where assets combining scarcity, utility, and independence from financial promises may become increasingly important.